Jake puts $500 a month into his savings account. Marcus puts $500 a month into an index fund. They both think they're doing the responsible thing. They're both partially right. But after 20 years, one of them has nearly $200,000 more than the other. And the reason why will change how you think about every dollar you're not investing right now. Let's keep this fair. Jake and Marcus are both 30 years old. Both earn $60,000 a year. Both have stable jobs, no consumer debt, and the same financial starting point. They've both read enough about money to know that saving consistently matters. They both committed to $500 a month, no exceptions. The only difference is, where that money goes. Jake opens a high-yield savings account. At the time, it's paying 4.5% annual interest, which is genuinely good. Better than the 0.01% his parents got. He feels smart about this. His balance grows every month. He can see it, touch it, move it if he needs to. It's safe. It's predictable. It's his. Marcus opens a brokerage account and sets up an automatic monthly purchase into a total stock market index fund. No stock picking, no market timing. He sets it and genuinely doesn't think about it again. His coworkers ask what he's investing in. He says, index funds. They nod politely and change the subject. Nobody is impressed. On day one, Jake has a growing savings balance and a plan that feels bulletproof. Marcus has a brokerage confirmation email and a number that will fluctuate for the next 2 decades. It doesn't feel like anything is happening. But something is. Let's run the numbers through year 5. Jake has been depositing $500 a month into his high-yield account at 4.5% interest. His balance sits at approximately $33,000. That's $30,000 in contributions, plus about $3,000 in interest earned. He logs in every week. The number goes up reliably. There are no surprises. He sleeps well. Marcus has been putting the same $500 a month into his index fund at a historical average return of roughly 10% annually. His portfolio is sitting at approximately $38,500. That's $30,000 in contributions, plus about $8,500 in market returns. The gap after 5 years is around $5,500 in Marcus's favor. Not dramatic, not the kind of number that makes anyone change their behavior. Jake looks at the scoreboard and isn't worried. His account is safer. His account is guaranteed, and he's not wrong about that. But safety has a price, and year 5 is too early to see what that price actually is. Here's what's happening. Underneath the surface, Jake's money is earning 4.5%. The historical average inflation rate is around 3 to 3.5% annually, which means Jake's real return, the actual purchasing power he's gaining after inflation eats its share, is somewhere between 1 and 1.5% per year. His balance is growing. His wealth, in real terms, is barely moving. Marcus is averaging 10% annually. After inflation, his real return is closer to 6.5 to 7%. His purchasing power is compounding at a rate that Jake's account mathematically cannot match. This isn't a theory, it's arithmetic. And by year 10, the arithmetic starts to show its teeth. In year 10, Jake's savings account has grown to approximately $75,000. That's $60,000 in contributions, and $15,000 in interest accumulated over a decade. It's a real number. It's an emergency fund that could survive almost anything. He's proud of it, and he should be. Marcus's portfolio has grown to approximately $102,000. That's $60,000 in contributions and $42,000 in market returns. The gap between them is now $27,000. That's a car. That's a year of someone's salary. That's not nothing. And here's the part that matters. The gap is not growing linearly. It's accelerating because compound growth doesn't add the same amount every year. It multiplies. The gains on Marcus's gains are now generating more new wealth each year than his original monthly contributions. That curve is just getting started. Jake sees the gap and feels something he didn't expect. Not alarm, exactly. More like a quiet unease. He starts reading about investing. He considers moving some of his savings into the market. But then he remembers 2008. He remembers March 2020, when the market dropped 34% in a single month. He thinks about what it would feel like to watch $75,000 become $50,000 on a screen. And he leaves the money where it is. That decision is understandable. It's also costing him more than he realizes. Marcus is not immune to fear. At some point in year 8, his portfolio dropped 22% in 4 months. On paper, he lost over $15,000. He didn't sell. Not because he's emotionally disciplined in some superhuman way, but because he automated everything and made it deliberately inconvenient to panic. The contributions still went in. The reinvestment still happened. The recovery eventually came. And every dollar that stayed invested through the drop participated in the recovery at a lower price. That's the mechanism most people understand intellectually, and almost nobody executes emotionally. Now, let's talk about what nobody mentions. When they tell you to build an emergency fund, the standard advice is 3 to 6 months of expenses and savings. That's legitimate advice. Jake took it seriously and built far beyond that. But there's a difference between an emergency fund and a permanent savings strategy. An emergency fund is a tool. Jake turned it into a destination. His $500 a month was never meant to sit in savings forever. It was meant to protect him long enough to let the rest work harder. He got the protection right. He forgot the second part. By year 15, the story has fully separated. Jake's savings account, still at 4.5%, now holds approximately $122,000. 15 years of discipline. 15 years of consistency. A genuinely impressive number by any normal standard. Marcus's portfolio is sitting at approximately $207,000. The gap is now $85,000. That's not a car anymore. That's a down payment on a house. That's 5 years of college tuition. That's the kind of number that determines whether retirement is comfortable or just survivable. And it came entirely from the difference between 4.5% and 10%. Not from working harder, not from earning more, just from where the money sat while time passed. Here's what people get wrong about risk. They treat it like a fixed thing, like the market is either safe or dangerous. And your job is to figure out which one it is right now. But risk is not binary. It's a spectrum. And the risk most people forget to measure is the risk of not growing. Jake's savings account feels safe because the number never goes down. But a number that grows at 1% real return over 20 years is quietly destroying the future version of that money. Inflation is not dramatic. It doesn't crash. It doesn't make headlines. It just silently reduces what your dollars can buy every single year without exception. That's a risk too. It just doesn't feel like one. By year 20, the math completes its full argument. Jake has been depositing $500 a month for 20 years into a high-yield account averaging 4.5%. His final balance is approximately $190,000. That's $120,000 in contributions and $70,000 in interest. It's real money. It's 20 years of discipline made visible. Marcus has been putting the same $500 a month into a total market index fund for 20 years at a 10% average annual return. His portfolio is sitting at approximately $382,000, nearly double. The gap between them after 20 years of identical contributions is $192,000, almost as much as Jake's entire balance. That gap didn't come from working more. It didn't come from taking on debt or starting a business or picking the right stocks. It came from understanding that time and rate of return are a multiplication problem, and that small differences in the rate compound into enormous differences in the outcome. Here's the fair counterargument, and it deserves to be taken seriously. Marcus's 10% is a long-term historical average. It is not a guarantee. There are real 10-year periods in market history where returns were flat or negative. If Marcus had retired in 2008 with his entire wealth in equities, the sequence of returns would have hit him brutally. Jake's money was never at risk of that. And, in a genuine emergency, Jake could access every dollar in his savings account immediately, at full value, with no market timing required. Marcus might have had to sell at a loss to access the same cash. Liquidity is not nothing. Stability is not nothing. The psychological value of a number that doesn't drop is real, and it keeps people invested in a strategy they can actually maintain. A plan you can stick with through fear beats a theoretically superior plan you abandon in year 3. But here's the thing. The lesson was never savings versus investing. The lesson is always the same. The real cost of any financial decision only reveals itself when you run it all the way to the end. Jake made a careful decision, a responsible decision, a decision that made complete sense in isolation. What he didn't do was ask what it cost him in 20 years. That question is the only question that matters, and it applies to every financial decision. That feels safe in the moment. The mortgage you paid off early instead of investing the difference. The car you leased for the lower monthly payment. The raise you got at 38 that your lifestyle absorbed before you could redirect it. The trap is never obvious from the inside. It always feels like the responsible move. It always looks like the careful choice until you run it forward and see what the careful choice actually cost you at the finish line. So here's the question. Not whether you're saving. You're probably saving. The question is where. Because if your emergency fund is funded, your short-term expenses are covered, and you're still parking long-term wealth in a savings account because the market feels risky, you're not being careful. You're being expensive. And 20 years from now, that difference will be sitting in someone else's portfolio. Ask yourself one question. When was the last time you actually ran the numbers all the way to the end? Because that's the only number that matters.